Oh my God, let's make this fast. It's so humid out here right now.
You like humid.
I don't like humid. I like hot.
Oh, you look good in humid.
I look good in humid, sweating, sweltering.
I don't look good in humid.
Changing shirts every 10 minutes. Let's get into it. Today, ladies and gentlemen, on Skiptown All-Stars podcast, we have a very special guest. His name is Chris Collins. I have known Chris as a television editor for years and years and years. He, however, has started a venture called Amity Cash Flow. I'm very excited to present him to you today. He is an operator when it comes to multifamily apartment investing. And for those of you who want to consider passive income rather than trying to buy all of your own little properties and managing them, you're going to love this episode with Chris. Let's get it.
Check the mic and make sure it sound right, boys.
Hey listeners, ever wonder what it would be like to blow up your comfort zone at the tender age of 50? Well, we did just that. When our last kid went off to college, we hit the road in search of a new hometown. Now we bounce from city to city and bring you along for the ride. This is the Skiptown All-Stars podcast.
Welcome back, All-Stars, to a special edition of Skiptown. You know, I always say that, but for me, this one is very special. Before I get into those details, I would ask that you please like and subscribe on YouTube, rate us on Spotify, and give us a nice review on Apple Podcasts. It all goes a long way. And without further ado, are you as excited as I am?
I am. And don't forget, because we're going to ask Chris a ton of questions. Check out the quiz on Instagram. See if you remembered everything Chris said.
He's about to drop some knowledge. So without further ado, my friend Chris Collins, who I've edited with for years, but has a venture of his own that he's been working on for quite some time. And it's become very successful. Ladies and gentlemen, Chris Collins, please introduce yourself.
What's up, everybody? Hey, this is Chris. I'm in Southern California, Newport Beach to be specific. Man, I'm really excited for this podcast. I get to be on a lot of these, but not often with people that I've known as long as James and Denise. So thank you for having me.
Of course.
I'm excited. My goal is to give as much as I can in a short amount of time. Let's give some value, give some background, whatever y'all want to know. Now I feel like there's a lot of pressure though, because I just heard that there's a quiz. So
there's no pressure. Okay, so let's just go.
Drop some bombs.
Yeah. Before we get into what it is you do and how you help passive investors and families looking to rent out at the same time, let's talk real briefly. When I first met you, you were an editor / drummer, and you and I were working on America's Next Top Model together. That was quite some time ago.
That was a while ago. I have a
What's a while?
career.
Let's put in perspective for everyone. What's a while?
2007, 8.
Okay,
probably
that's
worked
almost
together.
20 years. That's like what? 17 years.
I know, it's amazing how young you still look.
Yeah.
You know, I'd like to think I was probably one of the youngest editors in reality unscripted television. I was editing by 21, 22.
Yeah, you were a hot shot.
So,
Yep.
yeah, I've always been a very hyper focused person. So I have I set goals, I attack them really strongly. So when I showed up to LA, I already had multiple internships. I had a company I'd done producing wedding videos. I had worked at a commercial house making commercials. I showed up with a reel. I had emulated all these MTV shows. And when I showed up to work, I was like, here's a bunch of stuff. And, the response is like, whoa, well, we can't make you an editor today, but it probably won't take very long. So I was an assistant editor for maybe 6 months.
Yeah.
And that whole time I was editing every night for free. I know we didn't even jump into this, but yeah, I've been an editor this whole time. And when I started, I literally would go around to all the editors that was working on the show that I was assisting for. And I would say, hey, can I edit anything for you for free tonight? So I would work till, 8 o'clock or whatever my shift ended. And I would work till 11 or 12 every night, just editing stuff, whatever I could get my hands on. And in the morning, I'd hand it to the editor and go, hey, do you like this? Do you not? If you don't like it, no worries. Throw it away. It doesn't matter. But if you do, maybe you can use it and you don't have to do that work. And I think now as an editor, I'm like, man, if an assistant would edit stuff for me for free and I could just show up in the morning and put it in my episode, like what a great benefit. But no one else, I don't know, no one does that stuff. No one wants to put in all this extra work. And I've always been someone that does the extra work. So, and
Yeah.
that's probably why we're here talking about this whole other business I created over the last 10 years. So,
Well, the
yeah.
reason I was so, I said, wow, when you said you were an assistant for 6 months, because if you don't know anything about working in Hollywood in production, no one is ever an assistant for 6 months. They're an assistant for 2 years.
Yeah.
And that's, that's the track. So for you to have jumped from assistant to full-fledged editor in 6 months is like unheard of.
Yep.
Thanks. That was my goal. But I also didn't know any of that. Like no one told me these rules. No one said you have to be an assistant for years before you finally work your way up to the editor chair. I just showed up guns blazing, like, how can I add value? How can I help here? I didn't have any expectations. I really got very lucky, to be honest. I mean, I didn't know you got paid well as an editor. I just know that I loved doing the job. I started by editing skate videos with me and my friends when I was growing up with, VCR to VCR, running tapes back and forth, and I would add audio with a Discman and RCA cables, and I was just doing it for fun. And then I went to school, like I said, started getting internships and working as much as I can in the field in any form that I could. And I honestly, I didn't even know what you got paid till I was like an AE, and I'm like, oh, I guess that's how you get paid as an AE. And then I started hearing kind of what editors are making. I'm like,
Yeah.
what? Like,
Yeah, it's like,
I just lucked out to end up in this career that you get paid very well. So I felt very blessed because I definitely have that. There's that phrase, enjoy it, like do what you love and you'll never work a day in your life. Like that's how editing has been for me. It's just, it flows out of me. I'm a creative person. People call me the creative investor because that's kind of my background and how I think of things. I think things through and I try to think outside the box. So it was a nice thing for me to end up in a career that I could do something. But then I had to figure out what to do with the money, right? That's a whole other part of this.
Right. Well, I mean, as they say, good fortune prefers preparation, and you were cutting your teeth, getting this stuff, getting your career, getting your chops ready to go in television. And then, reality unscripted exploded. I know for a fact, and I've always been a little envious, you have been like one of the main guys cutting Shark Week every single year. Tell me about that.
So I appreciate that. I love that I can be known for that because I've always loved sharks. I've always been terrified and fascinated by them ever since I saw Jaws. And I had shark jaws in my college dorm room on my walls. I just was in love with sharks. So, when I moved to LA, I wanted to work at MTV because I wanted to do music television. I love music and I wanted to edit. But then there was always this thing in the back of my mind, like if I could ever figure out how to edit Shark Week, like that would be a dream.
Yeah.
And I came in for an interview at Gurney Productions
Right.
to do a sci-fi show, I think. They're like, hey, we need a supervising editor for this sci-fi show. So I came in for this interview and I looked up on the wall in the offices and there were Shark Week posters.
Everywhere.
And
Yeah.
for those of you that don't know, different production companies create Shark Week. It's not one company. There's usually a small handful that make a week long amount of content each year.
Yeah.
And I said, wait a minute, do you guys do Shark Week? And the answer was like, yeah, we do. I'm like, when do you do that? And they go, oh, we just wrapped, so we won't do it till next year. And I literally looked at the guy in the face and I said, I'm going to work here until next year and I'm going to edit Shark Week. And they went, okay. Like they never met me before. This is just based. I'm in this interview based on a referral. And I told them straight, I'm like, I'm going to be here. I'm going to edit Shark Week. And so I stayed there the entire year. And then it's coming up to the next year's Shark Week. And this whole time I've just been force feeding my way into this.
Right.
It turns out the supervising editor at this company that edits Shark Week there is like a master.
He really is good. Yeah.
An incredible editor. His name's Paul. And I realized that you don't just get to do Shark Week. It's not just any editor that gets to do it. They're very protective because Paul has worked so hard to create, and he really does. I mean, I've told him this many times. He makes the best Shark Week episodes of any of the companies. They're the best sound design, the most dramatic, the best storytelling, and the best footage, really. Jeez. And so to get in as an editor with him was a very hard task because he has his pick of, anyone he
You've
wants.
been
He
there
wants the
for
best
a
editor.
year. You've been there for a year. Get out of here. All you had to do was buy him a coffee, right?
He's a tough egg.
If only it was that easy, Denise. Because
I remember Paul. In fact, he showed me one or two things on, when you're speeding up footage or slowing it down or tempo and matching those speed up, slow downs to the music. The things he showed me while I was there, I still show other people today. Mm-hmm. So you're right. He was a really good editor.
All right. How'd you get him to do it? How did you do it? What was your?
So I kind of proved myself at the company. So the company had faith in me, and I got kind of forced on him at that point. And you could tell he was kind of like, okay, Chris, whatever. And I just went at it full force, and I created the best, amazing television content that I could. So the first time he saw it, he instantly had that comfort of like, oh, Chris has got this. Like, I don't have to worry about Chris anymore. And then we worked together for years after that. He would go out and shoot footage, and we'd talk about the story, and I would be here writing and crafting the story. And I learned a lot about editing from Paul and watching his edits and how to tell dramatic, impactful stories. Really, it's a tough thing to make sharks come to life. When you watch it, it seems like very easy because sharks do the thing. And then you think about, watching a week's worth of footage with a few shots of sharks and how to make that dynamic. It's like, well, give it to me and I'll give it back to you and it'll be amazing. So that was, and I've been doing Shark Week, 2012, 13, I think was my first Shark Week. So it's been a while doing that as well.
Okay. So you're still doing it here and there?
Here and there. Yeah. I'm still, I know we'll talk about the real estate thing, but I still edit here and there. It's okay. I don't think I'll ever stop editing. I call myself semi-retired at this point. Like, I don't have to edit for the money. I just love the craft. I love what I do. The money doesn't hurt, of course. I've taken buy more real estate with it, but I've just come to a point now where I work with people I like to work with. I don't just take shows just to fill up my calendar, so to speak. I'm really looking for material that I like. I turn down quite a few shows these days, and I want to work with people I want to work with. So, if something doesn't sound good, I just pass on it.
Hi, listeners. Thank you for stopping in on this week's episode. We're so happy you're here. I did want to mention something to you. With regards to this episode, I think it's really important for anyone who buys a new home in a new location to realize that if they're going to start an at-home business, they can keep their home address and their business address separate. How do you do that? You do that with a virtual mailbox. James and I use Anytime Mailbox for all of our mailing needs, and we love it. If you are going to start an at-home business and want to keep the business and the home separate, get a virtual mailbox. It's perfect. You can go to our website, skiptownallstars.com, and click on the link Anytime Mailbox to learn more about a virtual mailbox. And if you click on that link, you get a 10% discount. Anytime Mailbox is happy to offer a discount to all of our listeners that are interested in a virtual mailbox. Now, back to the show.
It sound right, boy.
Okay, so against this backdrop of editing throughout this process, you have a family, and it was always in the back of your mind that you wanted to do something bigger for them. So tell me how you got started on the current path you're on.
Yeah, it was a really impactful conversation I had accidentally. It really is. So in television, as you know, and I don't know if your viewers know, but it's all freelance. There's no retirement. There's no long-term plan other than most editors and producers, you make as much money as you can, and then you hope to softly retire and kind of hope that money pays for your bills until you die. Right. And so I had a conversation with an editor who is in his, I would say, early 60s. And I was talking about retirement, and I was setting up, tax strategy and planning and all this stuff. And he goes, yeah, I got to figure that out. And I was like, wait a minute.
Wow.
You're trying to figure that out. What does that mean? And I realized we have this responsibility to take it in our own hands and figure out our own finances. No one's going to do it for us.
Right.
So I made a very, very conscious decision to focus on the financial side of life. I've always been entrepreneurial and savvy to that world for sure, but my money was always tied up in the stock market. It would just kind of go up and down. But it's the same story. You hope it's a big enough pile so when you quote unquote retire, you can eat away at that until you die. And hopefully you didn't spend it, all of it. But if you do, hope for the best. You don't want to go back to work at 85, but you never know. So I realized I need to set something up that I can have streams of income, like different business verticals that are sending me money every month so I can stop working, but the money keeps coming in, and something that will keep going on forever as much as possible. Right. So I realized that rental, investment real estate does that, right? Like if I just own a house and I rent it out, it'll pay me a check every month. Like, it's not that complicated. I think it seemed like such a bigger concept. And once I dove into it, it was very simple. If I have 10 houses and they're all paying me rent, that's 10 different income streams every month. And I could spend 100% of that money. And then next month, the same amount of money would come back in. And I'm like, oh, I should just do that, and build out as much of that as I can. So that was what I started to do, is just take all my money from editing and just funnel it into real estate and trying to buy real estate. And that was really the start of it. It was just this realization of I have to have something long-term that I don't have to be working and grinding this out and hoping I have enough money before I die, and also to take care of my family.
Right.
Were you buying real estate in Los Angeles?
No, I mean, I had a condo in LA, but not an investment property. So I started buying out of state.
Where was your first investment property located?
Memphis, Tennessee.
Oh, wow. Okay.
Yeah. I started learning all about the different types of markets and the different price points, and looking at the numbers of real estate. And if I buy a property, what is the mortgage cost, and what can I rent it for, and how much does that leave me afterwards? And some markets are more cash flow driven. You can buy a cheap property and rent it out for a lot, but the property is not going to appreciate a ton. It's going to just kick out cash flow every month. And some markets, LA is a great example. It's very expensive. You're not going to cover your mortgage at all with your rent, but the property is going to appreciate a lot and you'll be able to sell it down the line. So there's different plays, I would call them. There's different understandings of how the markets work. And Memphis, Tennessee is one of those cash flow markets. It's inexpensive to get into. It cash flows right away. Your rental income can definitely cover your mortgage, insurance, CapEx, budget management, all that thing. So you have money left over at the end of each month. So that's what I wanted to start with, is just get in, get some cash flow going and feel this out and see how it works.
Got it. And was that a condo? Was it a house? What was your first investment there?
First investment, I bought 2 houses next door to each other. Okay. New construction, new builds that I figured would have little to no issues with them. They're brand new, right? We'll rent them out easily. People always want, if you could live in a brand new home, why wouldn't you rent one of those? We'd have very little to no maintenance because they're brand new. And learned a lot through those, even brand new properties, you still learn things. I dealt with property managers that send you bills for expenses that don't quite make sense. And when you ask them about them, oh yeah, I realized, like, I would get billed, $650 to fix a stove. And I'm like, wait a minute, how much does it cost to buy a stove?
Did we replace a stove? Yeah.
Yeah, man. I'm like, I'm looking at Home Depot. You can buy a new one for $400. Why are you fixing it for $600? Oh, well, okay, yeah. I guess we'll look at those numbers again. Okay, sure. Wow. So learning through that, learning about buying, something I know now is the term is absorption. It's like how many units are needed in an area. So I bought 2 houses in a development really that was going up around. So there were a bunch of new houses. And all of a sudden I realized, well, now I just have 2 empty houses, but there's 12 other ones around me and they're all brand new. But what makes someone want to rent mine versus the one next door or the one across the street? They're all just as nice. So learning that, finding a home in a market that has the demand for a renter, and eventually we rented them out. It wasn't an issue, but sat for, one of them sat for a couple months. The other one sat for 4 or 5 months before a renter came in, because they were just filling up the community with other renters, and houses coming online, popping up all within a few months of each other. There's no guarantee renters are going to be there. So dealt with that. And then dealing with a management company seems hands off, but they're always calling you for something and you're always calling them for something to keep track of things. So I'm a big learning experience person. I want to learn. I want to feel it firsthand. I want to have with my money on the line. I did all my learning and reading and research beforehand. And at that point, it was like time to buy and go feel it out. So yeah, bought a couple houses in Memphis, Tennessee, and overall, definitely a success and a learning experience.
Do you still have those 2 houses that you started with?
No, I sold those when I made a pivot into multifamily, so large apartment complexes. And after a while, it didn't make sense to have the houses. I'd rather have the money into apartments. And so at some point, the one of them was vacant for like a few months, and I was frustrated, and I just sold them in like a month or two. I was like, just sell those and give me the money, and I could put them into something else. So made a good chunk of money on those. I mean, I cash flowed the whole time, a couple down months here and there, and some expenses, but cashed out for a profit and just turned around and put that money into multifamily.
How long did you have the houses before you sold them? Just curious.
Let's see, I bought those maybe 3 or 4 years.
Wow, you didn't hold on to them for like a super long time then. So they were
No.
still like really brand new when you sold them. They're only 4 years old and you made a profit and had cash flow the whole time.
Yeah, definitely.
That's great. Okay, so then you said you sold those and you began in multifamily. Why don't you tell us what Amity Cash Flow does specifically, and why you felt at that time multifamily unit investing was sort of the key to your future financial success?
Yeah, I'll back up before I talk about Amity. I'll just kind of how I got into apartments was really because Amity, my company didn't really become a company for a while. There wasn't really a need for a company. Amity was born, my company was born out of a need. And I'll talk to you about that in a minute. But I realized early on that buying houses one at a time it was going to be a slow process to get where I wanted to be. And every single house is its own unique individual set of challenges, its own down payment, its own loan qualification, its own issues with what does that house have? What kind of plumbing is that house? And if I'm going to buy 50 of these or 100 of these, it's like I've visualized how many phone calls I'm making about individual houses, and it just did not sound fun. And so I started learning about apartment investing, specifically something called syndication. And I didn't know this, but most large apartment complexes, if you look on any given street in America, these multi-million-dollar apartments, they're not owned by one rich individual. It's not like Joe buys them with, $20 million of his own money. They're owned by groups of people called syndicates. And it's basically passive investors pooling their money with an experienced operator who basically takes control and acts with that money. And then they come together to buy these properties as a group. It's really like a group buying or a pooling of funds to go and buy a big asset. And I realized,
that's so interesting. Sorry, I just want to jump in real quick. That's so interesting because, you see all these signs up around LA and it always seems to be the same 3 like real estate groups. I always thought they were I always thought it started out as maybe 1 or 2 partners and just grew into this sort of monolithic corporation that just buys all this stuff up. I did not realize syndication was as popular as it is.
So you might be thinking of the broker who's buying and selling, like representing the transaction. That's where you'll see the CBRE, Marcus and Millichap, NAI, like all the normal big names that are outside saying for lease or for sale. But the people that own them are groups like me, and we go in and buy them. So it's something that most people don't understand and wouldn't even think to look into because it seems too big. It seems too. I mean, this year we bought a $16 million property. We bought a $6 million property this year. We bought $20 million properties. So we buy large deals.
Right.
But, I'm like you and me. Like if I can be involved and we can do this, it's not blocking out people. You just have to know about it and get involved and learn about it. So I did that by getting to know people. I spent a lot of my time meeting individuals, learning what they do, learning how the multifamily space works, learning how the commercial lending side of it works, learning the ins and outs of, renting to 100 people rather than renting to one person in my house. So it was a big difference. But at the core of it, it's still what I loved about it was the basics are the same. It's like have a house for somebody to live, make it nice, manage it, and then find the right tenant. And then that's kind of it. That's the whole science of it, right? It's like put a renter in there that wants somewhere nice to live. They pay you rent every month. You have to make sure that they're taken care of. And then you move on and do it again.
That's pretty great.
What was your first, so you go out, you decide that you don't want to have 50 different houses, maybe just one building with like 10 units. So I'm guessing, what was your very first multi-unit building that you purchased, and how did you find the team or the group of people to purchase it with?
So when I decided to start investing in apartments, I decided to jump in as a passive investor. So I was going to invest with an experienced operator, and they were going to do the work. I was going to invest money and feel it out and see how it goes. So the first couple of properties I invested in was a 192 unit in San Antonio, Texas.
Wow.
And then an 84 unit in Lexington, Kentucky. And these are with operators that I've gotten to know for a few years at that point, enough to trust that, look, if I write a check for 50 grand in each of these and I can be a part of these large operations, I trusted that they would do a good job with that money, much more than, better than I would do. I mean, I didn't know how to run a large apartment complex at that point. So those are the first two. I mean, I never had I've never bought a 4-unit. I've never bought a 10-unit. Everything,
Wow.
The smallest
you jumped
property.
right in 190 some units.
Yeah.
Crazy.
Holy cow.
Yeah. It's but here's the thing, the bigger the property, the more, there's two main things. You get these economies of scale. One, the larger the property, you can have full-time management employed on site every day because the income supports it, right? The income supports a full-fledged business. You can have maintenance staff, your lender is looking at it like a larger business. And then also the larger the property, if you can raise the rent, do some work on the properties and raise the rent across the board. I'm not raising the rent on 4 units, like let's say I raise the rent $50 on 4 units. That's great, but it's only $200 a month of income. If I have 150 units and I raise the rent $50 times 150, then you get into some serious repercussions financially and your money starts moving at a faster clip. So I realized, wow, I can be a small part of a big machine. And I liked that, I liked that idea that this machine is moving in big ways and my money is moving right along with it.
Got it. Okay. So obviously there are a lot of pros versus the actual cons when it comes to, look, at this point you have an operator, you don't have to worry about the plumbing under the sink in unit 37 or anything like that. Tell me about some of the are there any pros to passive investing that you didn't anticipate that you're currently enjoying over owning just your own individual properties?
Well, there's a lot of pros. The passive nature of it was what I first set off to do, was to achieve some passive income. And passive income sounds like one of those scammy words. I don't know about to you. To me, it does. It sounds like, the thing you would see on social media and people are like, give us money and you get free money in return, or like, sell this product. It's like, okay, so that's why I wanted to feel it out myself. And so I did a lot of research first. But the difference is that you are actually a co-owner. Like I'm part of an LLC that owns this property. So I don't feel, right away I understood the difference in a lot of these scammy things you see on the internet versus this is you're part owner of the property. So once you do all the work up front of learning about the property, getting to know the operator, getting to know the business plan, setting aside your funds that you've worked really hard for, right? Like you go to work every day, save this money, and then you're going to trust this to somebody else. Yeah. But once you do that, it's 100% passive. The investors have no work to do. They don't have to get on calls and make decisions. They don't have to, track what the property managers are doing. They every year get a tax document that they hand to their CPA. And so the passive nature was the first pro. It's just, I haven't found anything else like it, other than passive investing in other assets like self-storage or something with other operators. But that's a huge one. The returns have been really great as a passive investor. I've gone on to now be like the active, I'm the operator as well, but I still do some passive investing. But the returns are I think great, what I would call risk adjusted returns, meaning you're getting higher returns in the stock market with higher higher risk upfront because it's a piece of real estate and things can go wrong. You're not investing in an Apple or Tesla, like these mega corporations. It's still one property and something can go wrong. Like, I mean, I've been in situations where like, oh, we had a drunk driver hit one of our units and like took out the corner of a building. Right. And, we had to move that tenant somewhere else and we're not getting rent for that unit anymore. Now we're waiting on insurance to fix something, or, some kind of water leak happens in a property and we have to wait for insurance to fix that, or we're fronting money from our CapEx budget to fix that. And so as a passive investor, I don't have to do any work when that stuff happens, but it does impact our income at that moment.
Yeah.
But other than that, I've seen great returns, I mean, it's been seen, this is across the portfolio. So some passive, some active, but returns are in that 16 to 30% annualized return. It's crushing the stock market, doing, I think, much better than a lot of single family rentals do. So that's been great. And then just to me, I love to learn. So personally, I'm selfishly enjoying the process of, I think buying a house is very, like it's I hate to say it now because I sound like a jerk, but it's kind of simple. You buy a house, you put a tenant in it and you let it sit there and they pay you rent every month. But when you're buying an apartment complex with this business plan in place that we're going to improve this many units, we're going to do some renovation work here, we're going to do some landscaping here, we're talking to the lender about this loan, and then we're going to modify it down the way. It's all this new stuff to learn. And I love that. Like I said, I talked about kind of the big machine. Well, big machines have a lot of moving pieces. So I was able to learn and feel that out and really grow as an individual, as an investor, and then in my understanding of finances and real estate.
That's awesome. So the education component is huge.
Absolutely. Yeah.
I have a question. Is the operator bonded? All I keep thinking about is you wrote a check the very first time for 50 grand. Is this like, I would be so hard pressed. And I know you said you had a relationship with this person. You knew them for a couple of years, but still, was there any when you wrote that check in hand? Because you wrote them two. When you handed him those checks?
So, I mean, that's one of the risks I talk about the risks with investors all the time. There's 5 main risks, but one of them is it's a people business. So the operator is just a person like you and me. There's no real checks and balances of if this person's going to take your money and walk away, right? So you have to do some serious background research and vetting of these people before you write a check. Absolutely. If you just meet somebody today and they're like, you should write a check and invest in this deal with me, I'm like, red flag, right? Because now I'm an operator on my side. And I know that when investors come to me looking to write a check today, I tell them like, look, cool off, like get to know me for a bit, get some emails from me. Let's get on a couple of Zoom calls. Let's meet for coffee. Like it's too much money in place to not have a good relationship with that person and really trust them. I mean, I know these people's families. I know their people's background. I know their business before and during real estate. So I get to know people pretty well. But even then, it's still the risk that that person fails you. It's pretty rare. I don't know if I have a good story about anybody that's directly scamming people, like literally.
Well, they're out there though. You just haven't come across that person because you see it a mile away. Yeah. But even then, I mean, it's a people business. You hire property managers. Those property managers could not do a great job. They could not show up to work. You're relying on your maintenance tech to show up and, be upstanding and do the work that you're paying them to do. So there are people all on the way. And anytime you have people in a business, it's a point of stress for sure in a business.
Right. Okay. So let's talk real quick though, because, you mentioned a figure earlier that one of your first checks was 50,000. Is there space anywhere on some of these deals for like maybe a smaller fish, somebody with 20,000, 25,
10.
like how does that 10? Yeah. Like, are there like, is it scalable depending on which operator you're dealing with? How does that work?
So the minimum check size, there's no governing body saying that this is the minimum we can accept. And I skipped over this a little bit, but along the way, right, I started a business where I'm now the operator. And so I work with passive investors who are looking to invest with me now. And I'm the one doing the work, and I have teams and we're buying properties. And so I've felt it firsthand, which is like the reality is we're going out and buying a $20 million property, right? And we're going to raise $7 million. The minimum check size is more a matter of how many people do we want to work with, right? Like how many K1 documents do I want to go through my accountant each year? How many people do I want to
paperwork for $10,000 a piece?
A lot of paperwork. So when someone says, "Hey, look, I have $10,000," the real answer is no. You're not going to be able to get into our deals. The minimum is usually between 50 and 100,000. And what I tell people is like, if you have 25 grand, either A, you have to be a previous investor, like you've written the $50,000 checks and you're like, hey, I really want to be in this deal. I just don't have 50 liquid. Like, can I do 25? Then I'll get you in. Or if it's, hey, we're at the tail end of our money. Let's say we need to raise 7 million and we already raised 6.5 pretty quickly. Sure, we can take a couple people with 25 grand and get that closed out. Typically, though, we're not going to let those people in. But there's another side of it too, which is, if someone is at the point where they just have $25,000, like they have, this is all their money they've saved in the world. I tell people all the time, like, I don't want your first 50,000, but I will consider your second 50,000 because I want people to have a nest egg at home, because this is risk, right? We're dealing with investments, and there's a risk that your money goes away, goes to zero. I've never had that happen with investor capital, but there's always that risk. So I want to make sure they have some money set aside. So someone who often has 25 grand or 10,000, that's usually the case. They think I've just saved $25,000. I'm like, cool, go save another 25. And now they really freak out at me, right? They're like, man, it took me a long time to save 25. And my response is like, okay, you might not be a good fit for passive investing in apartments. Like, this is a investment class that you have to have a good chunk of money to be in the mix, Right. So for people with less money, I always say, like, go work harder and save more money. Like, look at your personal finances and figure out how to save more money. And a lot of times that just means working harder at your job. Like, can you pick up some weekend days? What if you picked up 2 weekend days a month? What would that do to your bottom line at the end of the year?
Right.
Cool. Call me back in 3 years and you'll have a big nest egg saved. And if you allocate that the whole time, this is just going to go into real estate and don't spend it, then you can get somewhere, or start by buying a house, right? Like, if you had $10,000 or $20,000, you could buy a single family house and rent it out. And then you're in the game, and hopefully that house is appreciating. And what really that is a forced savings account. Like, down the line, if you sell that in 3 or 4 years, well, now that turns into 80 grand. And now you call Chris and say, hey, now I do have that 50,000 plus some left over on the side. Now we can talk. It's not something that, you should rush to get into this space. It's not like as soon as you save the money, deploy it into your first real estate deal, you can. But you want to be aware of it and try to get into it as soon as you can, I think.
When these buildings come up for sale, is it like a feeding frenzy between different operators? Like, does it work the same way as,
as a house sale?
As basically a house sale where everybody wants to get into a particular community, or in your case, market.
And they're overbidding and they're writing letters like, sell it to us.
Yeah.
Yes and no. So the reality is the assets that we buy are institutional quality. They're large. They don't get sold to mom and pop owners a whole lot. It's not, a couple at their house realizing, oh, I love the kitchen, we should buy that apartment complex, right? It doesn't work like that. When we buy properties, we are doing due diligence on the financials, due diligence on the market. We're running our own numbers and coming up with a giant spreadsheet. We're talking with our investors. We know what returns we need to hit. So when we're making an offer on a property, it's based on a long list of variables that we ran through a spreadsheet and it says that we can purchase it for this amount. Now, there's a phrase in our industry, and it's these properties trade. Like, when did that property last trade? So apartment complexes trade hands. It's kind of part of the business of apartments. Not many times do people buy these properties and hold them for 30 years. They usually sell every 3 to 7 years.
Why? Wait,
Interesting.
I want to know why why?
Well, mainly because each operator is going to buy it with a business plan in place. And the business plan is usually to improve that property a certain amount by renovating the units, by putting money into the landscaping, by maybe maybe they're going to redo all the pool furniture or redo the clubhouse. So they put all this money in with the goal of increasing rents. Well, there's a point where the rents increase because of the work you did. And now after you kind of see that biggest jump, then you're just letting the market generally raise the rents for you, but you capture the most like profitability in that first few years that you do your work. And then you see the rents rise. So that's a point where you would either want to sell it or refinance it and hold it for a long time. But the other thing is these properties have a lot of wear and tear on them, right? Apartments are not forever homes for people. So people move in, they move out, they move furniture around, they put different, you put a fridge in there, it gets trashed with 4 people living there. So there's just general maintenance needed. And so what one operator might do is they might spend money on the outside of the property, and that will increase rents a certain amount. And then they go, look, let's sell it and let the next person do all the interiors. And now we already spent a lot of money and we already captured a pretty good rent premium. Let's just take that money. Let's take some money off the table and go buy another property and do it again. So because it's a business and the business is generating money, there's always different plays that you're looking to do. And so for one person to do all of the different things, there's a lot of money behind it, and it might take a while to see the returns on all the different aspects you're going to do. But also, if you improve a property all the way up, so let's say you renovated every unit and you renovated the entire exterior and redid the plumbing and you redid the electrical, and there's nothing else to do on it, right? Well, who's going to buy that property from you? Well, at that point, you're going to have more like a hedge fund or someone who's looking for a property that is low return but extremely low risk. So they're going to buy it and just hold that property for 30 years, right? And it's a different buyer than someone who buys a property that has work that needs to be done, which is higher risk, but you get a lot larger returns when you execute that business plan.
Got it.
Okay, so I took you off track by asking,
That's okay.
Why you don't hold on to it longer. But you were explaining that because James had asked, do you come up against other operators? And you were explaining like you give a bid that you think is fair for all the research you've done. So are there must be other people like you that want the same building? I mean, I'm guessing. Has that ever happened?
Exactly. Yeah. And so what happens is there'll be, it kind of depends on the market cycle, but there's basically a presentation from the broker saying, hey, investors on my short email list, the broker is like the main person in the middle of the transaction. And we are communicating with a broker in a specific market. Hey, we want to buy the next property in your market, Jacksonville, Florida. Like, we want a property from there. And same with maybe 30 other people are contacting that same broker. Well, now that broker goes to those 30 people and says, hey, you guys have been bugging me about a deal. Here's a deal. What do you think? And then he takes offers from those different operators. And his goal is to do, the broker's goal is to do as little work as they can and get this property sold for as high a price as they can. So he wants to go to that short list first. From those offers, the next step would be a best and final where they say, hey, of those 30 people, let's say 5 of them, we think your offers are the strongest. And it doesn't necessarily just mean the highest dollar amount, but it's the highest promise of closing, because it's a lot of work to go through. It's a months long process to get a deal closed.
Wow.
And they're putting a lot of, the tenants are getting annoyed because there's people touring the units now and people with clipboards walking through and critiquing everything in their unit. And so you don't want to go through that if you don't think the buyer's going to close. So there is a group of people, and then that gets whittled down. And then they basically go to those 5 people and say, hey, what's your best offer here? We're going to pick in the next 2 weeks. We want your best offer. And like I said, it's not just the dollar amount, but it's maybe your terms are shorter, your terms are lighter. Maybe you're bringing more money to the table. So at that point, then they choose a buyer. You're awarded the deal, quote unquote, and then you have to buy the deal. So then we got to raise all the money. We got to do all our inspections, get our loan secured, finalize our business plan, and then ultimately property's bought just like a house would be bought. You know, the money comes to the table, the loan combines with that, and then we buy the property, and then it's ours. And we got to go start making a bunch of money on it.
That's nice.
So are there literally 10 people on a loan? Is that how it works in this situation?
That's a good question. So the nitty gritty of it. So the loan will be secured by usually 1 to 4 people. The investors are in a pool in a LLC. The investors aren't attached to the loan at all, which is one of the beauties of being a passive investor. You don't have to qualify for this loan, but somebody has to qualify for the loan. And so the lender is underwriting somebody in the general partnership team, or it could be a group of them to say, you all are strong enough to collateralize this loan. And so we trust that you guys, based on your financial strength, based on your track record and history, and based on the business plan you presented to us, we think that's strong enough to lend you, $5 to $10 million to go and buy this property.
Got it. And so now you're an operator. Let's talk about what markets are you in right now? Can we ask?
Yeah, today we're buying in Jacksonville, Florida. I just bought my 4th property there. Dallas, Texas. I have some property in Austin, Phoenix, and then Des Moines, Iowa.
Wow. Okay.
Today. Yeah, we just bought our 21st investment property this year. So
Congratulations.
been doing a lot, it's been yeah. I mean, along the way, I didn't talk much about it, but like at some point, my friends in the entertainment industry started hearing what I was doing.
Yeah.
And well, why are you're buying apartments? What are you doing? Like it was such a foreign concept to them. Right. And so after a short conversation, they usually say something like, well, man, I want to do that. Like, can I get involved?
Totally.
Well,
Denise and I have talked about it. I mean, I think it's, I think we're coming up on my turn at some point here in the short future. So
yeah, it's a valid question. It's like, honey, what are we doing with our money? How is it securing our future? Or are we just hoping on a few stocks that we've picked and we don't really know if they're going to go up or down?
Yeah.
And so a diversification into real estate is a great way to put your money. But then most people don't want to be landlords. That's the challenge. Like it can be a lot of work to even just buy one house, much less enough houses to secure your future where you feel like you can go on vacation all day and know you have enough money coming in.
Right.
So my friends started hearing like, oh, there's a way to do this passively and to write a check and you and your team do the work for us. Great. And so I started just with people in the entertainment industry.
Mm-hmm.
And we were buying property in San Antonio, Texas. So we bought a few with people in the entertainment industry. I partnered with my partners. I had originally passively invested with a few different partners. And so I selected a few of those and we talked about doing this more on an active basis together. So we teamed up. Okay. And I brought passive investors from the entertainment industry. And then we went and bought a 253 unit property in San Antonio. So again, we don't go small, we buy big properties. But,
wow. I love it.
Yeah, but it makes a lot of sense. And so, we bought and sold quite a few properties, and investors, some of the deals, they get returns along the way. Some of the deals are more of a put money in, and then in a couple of years, your money will double, maybe 2 to 3 years, but you're not going to get any returns along the way. Right. Some deals are more, you get a quarterly return and we hold the properties longer. And then when we sell it down the line, you'll get a chunk of money there as well. So we're still holding some from there. We're still holding some that are longer term holds. And then we have a few that we bought that are more short term holds. So yeah, so now investors, it's nice is for investors, they can come to me knowing they have access to a few different markets, that we have teams set up already with property management and local oversight from my partners that I've met over the years. And they don't have to, investors don't have to spend their time meeting people all over the country or flying all over the country. They can meet with me and get access to deals that make sense, that have a great opportunity financially for them, but they don't have to go spend their time in Des Moines, Iowa. They don't have to fly to Florida on a weekend. But now my investor base is a lot more varied because I've spread out from just the entertainment industry. I speak at a lot of conferences and events all over the country. And so I meet people all over the place. And so I'm always fielding calls from investors that are all walks of life now. And it's really it's an agnostic investor base, that you don't have to be a doctor or a lawyer. It's like people have money from all different walks of life. They just want to learn how to multiply it. And that's where I come in.
That's awesome. And so these conventions, and I've seen a lot of your social media where you're speaking on panels, you're in different cities, and you just mentioned nobody has to go to Des Moines, Iowa. I know that because I've seen photos of you in Des Moines, Iowa. So which is always great. I love following your stuff and where you are now. What kind of people go to these conventions, or how do they figure out, like, how do you even, because if you don't know about this sort of investing, how do you dig it out? You know what I mean?
I mean, I'm the perfect case study for that, because I didn't know about these conventions. I didn't know about these conferences. I didn't know about these groups. I literally just made a decision. I'm going to learn real estate, and I just followed a trail until I got there. So I started just by picking up a book, and Bigger Pockets was starting to come online around then. And so I would just meet people and I would ask them, who else should I talk to about this? And they'd recommend me to one of their friends. I'd talk to them about investing. And then they'd say, you should talk to this lender. And I'd call a bank and say, can you tell me about commercial financing, lending? I don't know. What am I supposed to ask you? But I just wanted to understand this.
Yeah.
And so it took a few years. And by that point, I'd already invested in a few different deals. I was already an operator at that point before I went to my first conference. So anybody can do it. It's just a matter of how much you want it. But now the access is a lot easier. There are more, if you just Googled, multifamily conference, a list of probably 5 or 6 will pop up.
Okay.
But to answer your question, the people that are there, there's really, I would say 3 main types of people that are there. There are people who just heard about this. I don't know. I kind of go to conferences of all kinds. Maybe they go to a crypto conference, and they go to a stock trading conference,
right.
They go to a e-commerce conference, and let's try this multifamily one. And they go there just to feel it out.
Yeah.
And then the next person is probably, I could say, the level up from them. They already decided, I want to invest in real estate. I want to invest in apartments. How do I do that with the best education that I can? And so they go there with a notepad, and they're focused, and they're listening to every panel, and they're taking notes. And those people, I think, see a lot of success because they're committing their time, they're committing their money to showing up to a conference. I mean, they're not, they could be $200 to $2,000. It's an investment, but it's not like that much.
Right.
And then the third type of person is operators. So people that are there to meet investors. So those are people like me who are on the panels. We're the ones speaking, we're the ones presenting, we're the ones helping the passive investors. And that's really how those partnerships are formed, right? I mean, If the passive investors have no expert to invest with, then their money will just sit. But if the operators don't have any investors, they don't have enough money to go and buy these multi-million-dollar properties. So you really need the two to meet. And it is a business relationship. We're going to go and buy a business and make some money. But it's also a friendship business. I feel like I go to a lot of these conferences, and sometimes I just end up hanging out all night with my friends. It's just that my friends group is now buying multi-million-dollar properties across the country. And we talk about, the multiple properties they own in Dallas, and how the market is going, and the conversations are just elevated business-wise.
Right. A good group of friends to have. Speaking of markets and all that, any predictions on, are there regions in the country that are like more of a sweet spot for you as an operator? Are there any cities you see in the next 5 to 10 years where you're like, and you don't have to give away your own research and trade secrets if you don't want to, but I'm always curious about these things, so I have to ask.
Yeah, I mean,
I guess are there trends? That's like,
trends.
Are there trends of places? Because it seems like there are, but I don't know in what you do. Are there trends?
There are trends. I mean, what you're mainly following is employment and population growth and people who move out. So migration trends as well. So between employment, population, and migration, the Sun Belt, quote unquote, so from Arizona across Texas down to Florida, that whole section of the country is getting more popular. There are a couple of small pockets like in the Carolinas that people are moving to. And then the other element besides those 3 is a political environment that's embracing and encouraging a business, right? They want landlords to succeed, knowing that we have to run a business.
Right.
States like California are not so much helpful to landlords, right? They're helpful to the tenants.
Right. Yeah.
So when you're looking at rental properties, it doesn't come up as a big win there. So, but for me, I look for the properties in markets that are stable but not sexy, I would say. So I mentioned
Wow.
Jacksonville, Florida. We've had a lot of success in Jacksonville, and San Antonio is another great example of that. They're big cities with a lot of population growth, great employment, diverse employment, not just oil company that comes in and it has a boom, and then when the oil's dry, they leave and that city's decimated, right? You want a diverse employment group. But no one goes, I want to travel to Jacksonville on vacation, right? No one travels to San Antonio on vacation if they have a week off. They want to go to Hawaii. They want to go to Miami. They want to go to these sexier cities. And those cities tend to be really expensive and highs and lows when the market goes up and down. I don't want that. I want stability. Like I said, I'm trying to de-risk my portfolio as much as possible, but I want to have a lot of demand for my units. Like it's the basics of real estate. Like there has to be a lot of people. So when I have a unit available for rent, someone wants to come rent it. And I've tried my hand in investing in different smaller markets across the country, and it hasn't been as successful, but I've never done it with investor capital. It's always my capital to try it out. Des Moines, Iowa, I mentioned, that's a city it's just on the brink of becoming a bigger city. So we're in before that happens, we can get it at a discount. So in the next 2 years, when it tips over that tipping point and everyone starts coming in, we already hold the properties already. So that's where you want to be. The Carolinas have been, if you don't follow real estate, it's like I speak in these terms of like, well, of course everyone knows the Carolinas, but that's not the case. Not everyone knows that. But the Carolinas have been exploding, a lot of the main cities in there, because it's such a nice place to live and the people are so nice. But the people come down from New York that are exiting New York head south, and some of them stop at the Carolinas and a lot of them end up in Florida. And Texas is kind of one of those other states as well, where people move to Texas for cheaper land, cheaper rent, but that's been tricky, and we can get into a whole 2-hour discussion about inflation and finance as well. So we'll skip that for today. But
it's interesting that you mentioned San Antonio and Jacksonville, because we've been to both, and you are spot on. Jacksonville is bustling. Like if you go there, there's traffic everywhere. But who would ever say, I'm going to go vacation in Jacksonville? And San Antonio is the same. I mean, other than the Alamo, nobody talks about the water walk or the river walk that they have, or like the really pretty downtown area. But that place is exploding. We have 2 friends that are in the medical industry, and they've talked to us about like how the city just keeps going further and further out. And what used to be San Antonio proper is now like 5 miles further, and now it's going. You know what I mean? So. Yeah, you talked about 2 cities that
pretty soon it's just going to connect with Austin. It's going to be all one big metropolis.
Yeah, that's happening. They call it what do they call it? The megatropolis, I think. But yeah, I've been tracking that. I have there's like an article that I have that they keep kind of updating it every once in a while. But that's definitely happening. Austin to San Antonio is connecting at some point, so it's already in the mix.
Yeah, for sure. So, all right. Well, this has been fantastic. Why don't you tell everybody where they find you?
So I'm pretty easy to find. You can find me on my website, amitycashflow.com. That's AM as in Mary, AMITY, cashflow.com. There's a contact page there. I'm all over social media at Amity Chris Collins. And then if you're someone who's looking to, potentially become an investor or learn about investing in multifamily properties, I have a free ebook that I offer that you can download for free. It's amitycashflow.com/ebook, and that will get you there for free. But I spend a lot of my time talking to investors every day. So if you're at a point where you're trying to learn or you have some specific questions, you can book a free call on my website under that contact page. And I think that ebook will actually help you a lot. It kind of walks you through the basics of investing in a syndication. What are the step-by-step, what you should be looking at as a passive investor. And I did it, I think, a pretty freaking good job, but I broke it down into like a 24-hour, how you can invest in your first deal in 24 hours. So what each hour of that looks like. And by the time you're done, you should be at a spot where you could at least make a pretty good decision and invest a good chunk of money and start seeing some returns in an asset class you might not have known about before.
I love it. I love it. All right. So if you find yourself in need of a bigger boat, you need to go to amitycashflow.com. Find my friend Chris Collins. Chris, you've always been a straight shooter, an honest guy, a positive force. I've always enjoyed the time we worked in office together. And I am grateful that you joined us for an episode today on Skiptown All-Stars. Thank you so much for your time and spelling this out for our listeners.
Thank you. I appreciate the two of you. I appreciate your listeners taking the time. It's such a cool podcast. So you guys take care. We'll talk to you soon.
Definitely, if you have a chance, everyone, go to amitycashflow.com/ebook. Download Chris's ebook. It's packed full of information. I did it. You should do it if you're interested in this type of investing. Can't thank you enough, Chris, for putting that together. All right, take them out.
Empty nest, full tank.
Check the mic and make sure it sound right, boys.